In this video, we discuss the current and weak economy and those mortgage rates. All that, way more. Stay tuned for that, and also be sure you uplift at least one person today. And we're starting right now. Hey YouTube family, happy Wednesday. Mortgage rates just passed 6%. How high will they go? At this point, only the Federal Reserve and time will tell. The good news is that the Federal Reserve has the tools necessary to reel in inflation. The bad news is that the devices that the Federal Reserve will use will hit many financial sectors harder than others. One of the most vulnerable sectors is the United States housing market. Looking back in time, the inflationary period that exploded during the 70s was subdued by the Federal Reserve. However, this was subdued only after the central bank forced interest rates into the stratosphere. And they didn't top out till rates reached 18% by 1981. This effectively cut home construction nearly in half by the following year, 1982. Now let's take that information and fast forward to 2022. The Federal Reserve has powered up its shields and entered defense mode against inflation yet again. We're already seeing higher mortgage rates, which have nearly doubled since December. Rates have recently spiked, but then seemed to level off in the middle of May. But this past Friday, rates began to accelerate yet again, pushing higher yet again. The Consumer Price Index has just hit a 40-year high to 8.6%, throwing many financial markets into a tizzy. What is the Consumer Price Index? Well, it's a measure of the average change over time in the price paid by urban consumers for a market basket of consumer goods and services. Here is the formula if you want to take a look at it and study. And if you're curious about 203K rehab loans and tips you really should know, you can check out that video by clicking up here on the card and leave a comment below if you like the content, or maybe let me know what you want to see in the next video. At the end of last week, the average 30-year fixed mortgage rate was just under 6%. According to Mark Zandi, the chief economist at Moody Analytics, he states, historically speaking, mortgage rates follow the trajectory of the 10-year Treasury yield. If that 10-year yield does indeed go higher, we could see mortgage rates surpass the 6% mark. Let's think back over the past 12 months. September marked the lowest interest rate this past year at 2.95%. And as of today, just about at this point, doubling that in just 9 months. This spike in mortgage rates is a rare moment in time. The only time in history that this has happened before is 1981. That is the last time mortgage rates spiked that high that quickly. This is an unadulterated economic shock to the housing market and definitely a huge setback for home buyers. Hey everyone, my name is Vasilios. Welcome to this channel. If this is your first time here and you want to get the latest actionable tips from a local realtor that actually save you time, save you money, and result in a smooth real estate deal, start now by subscribing and clicking that bell notification so you don't miss anything. And if you like the video, go ahead and like that video. Now, back to it. To put things into perspective, a homeowner in June 2021 wanted to purchase a property with a $500,000 mortgage at about 3% interest. They would see a monthly principal and interest payment of $2,135. Now at today's rates at almost 6%, that monthly payment and that exact same home mortgage would be $2,950. That is almost 40% higher monthly payment. Over the course of a 30-year note, that's $293,000 more in payments. Crazy. Now that's a good math equation if things were apples to apples. However, this really isn't the case. This is because over the past year, average home prices have spiked up to a record 20.6%. So even the same $500,000 mortgage is really closer to $600,000 home. Now you take the $600,000 home at almost 6% interest rate, the monthly principal and interest payment on that property would be $3,557 a month. Crazy. This is quintessentially the perfect storm for home buyers. Sky-high interest rates coupled with historic increases in home prices. Those prices, mind you, have shot up 37% since the beginning of the pandemic. This is why the local housing market is slowing in areas and we are having a non-traditional spring market. Many buyers are now unable to meet strict lender requirements. They have lost their mortgage eligibility or just don't want to spend that much money on a property right now. Hence all the headlines of a drastic housing correction. We have seen home sales of new and existing homes weaken and fall in the area. Also, every price change that is updated in the MLS has been a price reduction. According to Freddie Mac, the U.S. housing market is at the beginning stages of the most significant contraction in activity since 2006. This cool down is beginning to increase inventory levels. This increase in inventory will provide some balance and checks in regards to home sellers and builders. This takes away some of the pricing power that they have had in the past 2 years. Even with this new influx of inventory, we're still a very long way from the spring and summer markets of the past. The Fed believes they can slow down the housing boom to slow inflation, and they expect a 0% year-over-year home price growth. For too many folks, this is not nearly enough, but it is a healthy start to a more balanced market. Hey listen, if there is anything in the world that you want to talk about or you have a question, reach out anytime. Let me treat you to coffee. No obligation, really. 508-821-8835. We could talk about the weather, cars, real estate, racing, whatever. Now that you are versed on the current weak economy and those crazy high mortgage rates, you will want to follow this video up with this next one right up here that talks about why I love living in Milford and why it should be on your move to list. Also, if you think this video can help out a friend or family member, please consider sharing. And as always, thank you for watching. I'll see you in the next one.